Hey guys, what's up? Uh, Designing the ideal portfolio. This is probably the most asked question I've had over the last month or so. People are want to know what percentage of what position in the portfolio to allocate to it. And the bottom line is I can't give you a direct answer. We are all so different. Our risk tolerance, our knowledge in the sector, our financial positions, and our overall investment philosophy. These factors are what determine how you allocate money in your portfolio. And because each of us are going to be so different, I can't give you a direct answer. But let's talk about these in a little more detail. So we'll start first with risk tolerance. Risk tolerance is a tough subject. Nobody, or at least new investors, don't seem to have a good grasp of what their risk tolerance is. Unfortunately, they have to lose money before they know that they don't like losing it. And it's unfortunate, but that's really how a lot of us work. And this is something that I would be very cautious about, especially for a new investor. I think you want to focus on the low end of the spectrum, low end of the risk spectrum. Get your feet wet there, because you can still lose money on that end. There's many risk factors that come into play in the resource sector, but you're much less likely if you stick to the low end. So what's the low end? So the very low end of the risk spectrum in the junior resource sector, you have the producing companies that actually have, like a proven and probable reserves, and they're producing from those, whether it be gold, silver, nickel, zinc, whatever. They're producing from those mines. And then even in that spectrum, you can even have more low risk stuff that, these well diversified miners, like these big base metal miners like BHP, Rio Tinto, that span across the spectrum of base metals and really give you a nice diversified look at all those metals. And you don't get really a huge pop from anything because they're so well diversified. You also have royalty and streaming companies, and they actually might be the best bet for new investors. If you pick right. These guys offer you cash flow and with very little risk to the operational risks that come with producing companies. So that might be a good alternative. In the medium, you have developers, and developers are companies that have existing deposits. So they have a 43-101 resource on an existing deposit, and they're looking to expand that deposit and do economic studies along the way in hopes of having an economic mine, some time in the future, or preferably in most cases that this deposit that they outline or delineate will be purchased by a senior mining company because it shows great economics and such. There's their own set of risks here, but at least that metal in the ground gives you some backing to your investment. It gives you an anchoring. So the exploration risk of them expanding along strike and at depth or other satellite deposits, isn't a make or break. Whereas we move on to the high end of the spectrum, the exploration companies that have essentially nothing. It's essentially just an intellectual capital and a hope and a prayer that you're basing your investment on. And so, there is no backing to these companies. If they miss, you could lose 50, 60, 70% of your investment dollars. And, most people aren't ready for that type of loss until they experience it. So be very cautious, and you want to stick to the best of the best at all times in each of the categories. You always, in my view, want to stick to the best. Knowledge is a never-ending thing. All of us have are on a spectrum of knowledge, from the very beginner that really doesn't know anything about anything to the expert that has the geological, the financial, all control of their emotions, have all those things under control. There's very few people at that one end of the spectrum that are true, I don't even know what you want to call them, but the people that have it all set. And then there's a few people that I think in the sector that I've met that are pretty close to that end of the spectrum, but the rest of us are somewhere on that spectrum. And for me personally, I'm always, reading and trying to improve the knowledge I have in the sector amongst those categories. So, geological knowledge, financial knowledge, and this breaks down into accounting, the reading of balance sheets, the analysis of producing companies, With the developers and the explorers, I think you're mostly looking at balance sheets for red flags. You're looking for high amounts of debt, cash positions, and how they're burning their money. You want to look at how much these guys are taking for G&A, the consulting fees, all these kind of hidden things they do to layer on to extract money from the company and really force dilution in the junior, down the line. So these are the things you want to avoid or, look for. Your network matters, who you know in the sector and who you know in different jurisdictions. All these things play into how you take your positions in the sector. And for me, like, I have a really good network of people that I know, especially over the last 5 or 6 years. I've accumulated a really nice Rolodex, and I can ask various people their opinions on jurisdictions. I can ask people who actually live in those jurisdictions what's going on. The media can be deceiving at times and paint maybe a rosier picture than is actual going on. So your network matters, and take that into account too. Capital markets, again, how companies are structured, the different types of deals that take place, RTOs, IPOs, what's your knowledge base on this? How companies are formed. These are questions that you should be asking, especially new junior companies that you haven't heard of before. What's the genesis of the company? If it came from a shell, who controlled the shell? What's that group like? How much percentage of that shell did they control? How many shares do we think can come out onto the market? Those are different considerations that you want to make before investing in a new company. So ask that, genesis part. The more you know and understand about how those are structured, that's another big check mark on your knowledge. And then your general investing stuff. And this should be the broad basis of any investor in the sector. How you manage emotions, how you compute the general value of a company, and of course, dealing with the market dynamics. Markets, especially junior resource sector, move in cycles. And this kind of flows into with your managing of emotions, but you have to be ready to see how those bull and bear cycles move and be ready for those drawbacks like we're seeing today in the gold market. I think without a doubt, we're in a gold bull market, but sentiment has completely changed from a year ago. And we're at maybe the bottom of sentiment at the moment. Who knows? But the point is, you want to be ready for this. And this all flows into how much knowledge and experience you've had in the sector. Financial position. So we're all different here too. Even new investors, some of you I've talked to, and some of you are very well off, and nobody wants to lose money, but the more money you have, the more money you could theoretically afford to lose. Those people on shoestring budgets, in my view, even though you want to grow your portfolio, I think you should be sticking to the lower risk, the low to medium risk type of companies that give you more of a chance of being right. A mentor of mine said that you grow wealth in small steps over time. And at first, he told me that, and I kind of thought, I understand to a point, but I want to grow my wealth. And then over the last 5 years, he's absolutely right. You look at these different cycles and how they work. And for me, I continually take profits out of the market, and 30% wins, 30% gain on anything is very, very good. And you may target those 10 baggers, and that's great. But markets move in cycles. And if you look at a lot of those companies that were moving up 2 and 3 baggers, and people have held up to the top and now to the bottom of sentiment, you could have bought these companies now a couple times over that period and made that money and still hold out for that 10 bagger down the line. It's managing your expectation. It's such a big part of investing. It's something that I've learned myself, especially over the last 5 or 6 years. Okay. And then this flows in really nicely with this last topic. So the difference in portfolio, what your aim is, what are you trying to achieve with your portfolio or your investment dollars? Are you going for growth? Or are you going for diversification? Those of you that have large amounts of money already, maybe it's not growth that you're looking for. Maybe you're looking to diversify, like in this this landscape where money is losing value continuously due to low interest rates and money printing, maybe it's diversification that you don't want your money to lose out because of inflation on a yearly basis, and you want a minimal growth, but you don't want to take on a lot of risk. And then for diversification would be a great way to do that, especially in some of these the large resource stocks, like I talked about, on the low end of that risk spectrum. Specifically for this, I think the biggest point that can affect how you play your risk is the percentage of each company type that you put into your portfolio. So a person, in my view, that's looking towards a more growth-oriented portfolio, you probably want to look at a 10% or up to a 10% weighting per position. And remember, you only have 100% of your portfolio. So that's 10 positions. And so you want to make sure you choose right if you're going to do that. A 10% allocation means that, your portfolio can be impacted by 10%. And that's a big deal. Then as you move down there, like a 5% weighting for one position is kind of like in that middle ground where you're still having good growth, where a win on one company can still make a big impact on your overall portfolio. And it sort of minimizes the loss, obviously, if things go wrong, whether it's political or geological or whatever it is. 5% weighting will diminish that. So, and you can play around with those percentages, but I don't suggest, especially for new investors, that you go over 10%. For me, I rarely do, but it has to be for very specific reasons why I've done that. And I think I have the knowledge and the experience to take on that sort of risk. But I rarely stay there. It's usually like a short-term thing if it's above 10%. And as you guys know, there's roughly 20 positions in the portfolio right now. So it's more around that 5% weighting that I tend to like. Of course, if you're looking for diversification, if you get below 2.5% per position, obviously that's really minimizing the positive and negative fluctuation that you can have per position. And that's what people should, take into account. There's one of you that I talked to about the number of positions they had in their portfolio, and you can be extremely right, which this person was. But when the position is worth, like a 0.5% or below of your overall portfolio, really, it doesn't matter. It doesn't matter either way, really, what happens with that. It's not going to be a noticeable difference. So for some people that may not be a problem because you're just looking for a small win or diversification across your portfolio. But really take that into account. People that have 30, 40, 50 positions, even your biggest winners aren't going to be worth that much. And of course it does minimize your downside, which is important. But if your goal is to make 30% on your portfolio, you're going to have a real tough time doing that. So I think you need to take that into account. Okay. So that covers those main points. I think this is a topic that we need to discuss further. So if you guys have further questions about any of those specific things that I went over, then let's go through it, and I can try to answer those other questions, but make them specific questions about the portfolio allocation, and we can kind of go from there. Okay, thanks, guys.